you determine, what is the value of the business?
Beauty is in the eye of the beholder.
Sort of positioning the business to be able to sell it.
Very crucial, but it's also dangerous.
Gerrit Nortje is a corporate deal maker who helps business owners turn their life's work into generational wealth. Backed by 17 years in listed corporates, he doesn't just sell businesses, he engineers legacies.
People are there just because of nepotism, to be frank.
Rainmakers don't come along every day.
They just waste your time.
And you need to do that rather quickly.
What's the next steps?
I would sell the business.
Welcome back. My name is Hardi Swart, and for those of you that's the first time visiting our channel, this is the Family Wealth channel where we focus on retirement planning for families, entrepreneurs, and also for people that are ready to take on the next step into their retirement journey. So we provide quality content and we really focus on helping South African retirees prepare for the next act in their journey. There's one financial decision that can change everything in an instant, and that's selling your business. It's not just a deal, it's the moment your life's work turns into a bank balance, the moment you move from builder to steward. And for many entrepreneurs, it's the most dangerous and defining moment of their entire financial lives. Because what happens after the sale, both emotionally and financially, and even in your identity, can either set you up for success and freedom or leave you feeling lost and unprepared. Today I'm joined by someone who has a wealth of experience in the process of entrepreneurs and helping entrepreneurs exit their business. So Gerrit, welcome. What a pleasure to have you on the channel today. And tell us a little bit more, what's your background and why do you enjoy helping entrepreneurs selling their business?
Thank you, Hardi. Thanks for having me. I think my passion has always been, I've been trained as a chartered accountant. But my passion has always been the valuation of businesses. I spend a lot of time in corporate and eventually in private equity and corporate finance. My passion is really to value businesses. And it's exactly what you said is what I found is a lot of businessmen and business owners are excellent at operating their businesses and good at managing finances as well. But when it comes to valuing their business and selling their business, they sometimes out of their depth and it could be quite intimidating.
Yeah, I can imagine because my dad was an entrepreneur and he built a successful business and actually exited a couple of businesses when I was still younger. But it's a difficult process because you've got a value in your head that you think this is what the business is valued or what it's worth, but it's not always correct. So what's the first step? So how do you determine what is the value of the business? How do you value a business?
Yeah, I think your first step would be you need to find the right expert to help you value your business. It needs to be somebody with experience of what the market is like and sometimes in a specific industry as well. Get the right expert for that industry. It is, I think owners are very intimidated by this, but even experts are, if you put 5 of them around the table, they're going to get different valuations. So it's not something to be intimidated by, but I think it's important to get the right help from the start.
And I think what I've also seen with a lot of entrepreneurs is, you look at, let's say you've got a business and you're able to withdraw $1 million or $2 million rand a year from the company. The reality is, in order for you to sell that business and then invest the capital, to withdraw 2 million rand a year, you're probably going to need to have close to 40 or 50 million rand. So in the back of the head, instead of looking at the fundamentals, what's the business really worth, they look at what do they need in retirement, and that's the value they put on the business. But that's not always accurate. You have to have a formal way of actually valuing it.
Yeah, that's correct. I've had this plenty of times, exactly that. I've had clients tell me, listen, they want to buy a condo overseas. The kids are now studying there, and this is what the condo costs, and this is what they want for the business. And unfortunately, it doesn't work like that. Like any investment, a potential investor or purchaser of your business needs to look at the return. And that return needs to be realistic for the risk they are taking.
Of course.
So by all means, one must try and maximize the value of your business that you sell it for. I mean, you've worked your entire life for it. You can't give it away, but it also needs to be realistic.
Yeah, of course. And then also it's about the concept of a willing buyer, willing seller,
Exactly.
And if there's no market for your business or you're asking too much, there's always a sort of a symbiosis you need to find in that process.
So Hardi, it's a normal supply and demand. If your business is attractive in an industry that's currently attractive, there's going to be more buyers for it, and in that case, you're more likely to maximize the price of the business.
Yeah.
There are a few elements that you need to put in place that can make your business more attractive. Doesn't need to be in the correct industry, but there are measures that you can put in place, which you need to put in place over a long period to make your business more attractive to potential investors.
And then of course, when you do get to selling the business, then what's some of the tax consequences you need to consider? For instance, capital gains tax, and how would it be determined? If you started the business from scratch, so is your base cost basically zero, or what other factors would be sort of taken into consideration?
Yeah, that's an interesting question because it would depend on the specific situation. If a business was started off from scratch and the business doesn't have a high net asset value compared to the purchase consideration for the business, then you're likely to rather sell the shares because that will entitle you to a lower capital gains tax rate of, call it 18%, versus a company's tax rate. But if the company's got a high net asset value and you sell that business, in some instances, in a lot of instances, I've found that it's better to sell the business, the assets in the business out of the company.
So basically strip the assets out of the business and sell that.
Yes, and keep the capital gain in the company because you have a base cost that you can deduct against it. So if you sell the shares of the company and you get the capital gain in your own hands, you've got the problem of a estate duty. So
when you pass away, of course.
Yes. So those are also things to consider, but might lead you to rather keep the capital gain within the company and sell the business out of the company.
Oh, that makes sense. And so I mean, let's say we've got a client, and this person is now approaching retirement, and it's a family business, quite a profitable business, and he has a chat with his kids, and the kids say, listen, we're not interested in joining the business. And now the person wants to sell. The first thing is this process doesn't happen it's not a quick thing to do. It's quite a tedious and quite a timely process, and so what would your advice be? How long would you say does it take? Of course, it differs from every person, but what do you see would the process be in such a transaction?
I think the most important, and this is not in all cases, but if you were to want to dispose of your business, the most important thing is that management needs to be in place. So your succession planning needs to be in place. If you are going to be the person that's exiting this business, and you want to increase the pool of likely suitors for your business, you would need to have succession planning in place. So you need management in place, and the track record needs to be there. So this management needs to be there for a 2-year period where they've been able to generate the same profits you were generating when you were managing the business for at least a 2-year period.
Yeah. So basically, if you are looking at selling the business, is sort of positioning the business to be able to sell it, meaning that you sort of that you have the key man risk of you being the person that drives all the profit in the business. Yeah. So that's probably crucial as well.
Very crucial, but it's also dangerous. I've seen people remove themselves out of the business where they are the rainmaker. And to be honest, rainmakers don't come along every day, and so you've got to be careful in that process. You've got to make really sure that the person you've identified, that you've held the hand, you've checked that they're able to do what you did and are able to generate sales, the same sales that you were generating.
Yeah.
So because I've seen people bring people in where they've had a very profitable business, and within a year and a half after bringing in an individual, the business was almost at a loss-making position. So yes, you've got to plan ahead long before and make sure that person is the right person. And then look, it's not always the case. we talk about a private equity acquisition where you're buying a standalone business. But in the case of a bolt-on business, so if I were to sell one of my clients' business to a company that's in a similar industry,
Yeah.
then in most cases you do not want that management.
Of course, yeah.
You could likely save all of that operational cost, and just swallow the business in. So it's not always, I don't want to. If I can advise clients, but it's not always the case that you need to plan like 3 years in advance. But if you do this, it is, it's healthy business practice.
Yeah.
And if your business is healthy and it's attractive to buyers, then and you structure your business in that way from day one, then you're likely to have a successful business, and you might not even want to sell it.
Yeah, yeah. And one of the things that always interests me as well, so you've got these very successful family businesses, but for some reason, a lot of the times you'll also find that in the family business, you've got the mom and the dad might be being the founders of the business, but then the son or the grandson or everybody's working in this business. And oftentimes, these people are there just because of nepotism, to be frank. And not always, and a lot of times we see that people actually live out of these family businesses where they actually draw a small salary, but a lot of the expenses, the vehicle, the cell phone, the Wi-Fi, a lot of the operating expenses, the family actually lives out of this business, So it's probably also important to clean up the business before you like looking or thinking about selling it.
Look, it is preferable. But one of the first items we address when we value a business is calculate normalized earnings. So what we would do is we typically add back those items.
So just what is normalized earnings?
So you've got your earnings that you report in the financials.
Yeah.
But if that particular business that you used that as an example were to be swallowed up or bought by a corporate company,
yeah,
they would put corporate structures in place. There would be no personal expenses going through. So in their hands, those expenses wouldn't exist. So after the effective date of the transaction, all of those expenses would cease. So those are the type of expenses one would add back.
Okay. So if the founder was putting a very big salary with maybe dividends and a bonus, exceptionally high, then they work that back because it's not normally an executive would not necessarily be paid the same sort of remuneration. So would that be worked back as well?
Exactly.
Example.
Exactly.
Okay, that's interesting. So that makes it a bit more sensible. So also, when it comes to family businesses, if you have a situation where it's a family business and the founder is contemplating selling, or the founder has this perception that I'm going to hold on to this business for the next generation, but the next generation doesn't have a real interest in taking over the business. So what would your advice be in such a case? Because my perception is, and I might be wrong, please help me right, is that oftentimes if the next generation isn't really willing or able to take over the business, it's much more prudent to rather sell, than sort of giving them this business and setting them up to failure. What would you say in that regard?
I think the very important to evaluate whoever the family members are, see whether they do have a passion or an inclination to manage a business, and you need to do that rather quickly, because I've seen businesses fail as a result. I've even seen a client where he had a very successful business. He then got his son-in-law to manage the business, and he was a prudent and good businessman. So what he did is he pulled in a corporate guy in the same industry, and this corporate person, managed the business alongside his son-in-law.
Yeah.
And again, within a 2-year period, that business went from a very profitable business to a business that was at a break-even. So you've got to make that decision very quickly. But in my opinion, rather than pushing your kids into a career that's not their passion, I would sell the business and make some of those proceeds, buy a smaller business or take a smaller risk and start small with whatever this family member's passion is.
Yeah.
You're doing them injustice by pushing them into a position that they're not suited for.
And I've seen it in so many times. I mean, to take my own example, my father was a farmer, and quite a successful farmer, and he passed away. And even though myself and my brother, we loved the farm, we loved the outdoors, but loving the outdoors and loving a farm and being a farmer is two different things, you know. And we decided that it would be a better decision to rather let go of the business, you know, rather sell it and invest whatever we made, you know, rather than trying to do something that you're not inclined to do. And I think that's so important, that sort of a lesson for many entrepreneurs is don't try to force or to don't force your dream on your children, because that's not necessarily what they want to do. And that's important, you know. Rather take the funds, and you can set them up with another business, or you can help them financially if you want to, but don't force your dream onto your kids.
Exactly. Yeah, I think, you know, as you say, you would be doing them an injustice. And, you know, a lot of these, and, you know, an entrepreneur that's built a business from nothing, you know, and it's a 30-year business, there's an emotional attachment to that business, you know, and they don't want to see what they've built die, okay? But, you know, rather put the structures in place, sell the business, you know, and the business can persist, than giving it to your children, putting that obligation and that heavy weight on their shoulders for something they might not, you know, that they don't have the skills to manage.
No, I agree. Gerrit, from your experience, what are some of the most common mistakes you've seen in practice when entrepreneurs are contemplating selling their business?
So I think the most, the biggest mistake I've seen is that they haven't planned ahead. You know, I think what an entrepreneur should ask themselves is, what kind of business would I want to buy? You know, if it's a standalone business that I'm buying, what would I want to see in place in that business? And that's a healthy way of looking at it. Unfortunately, a lot of these business owners wait too long, and by the time they need to sell the business, they haven't planned and strategically planned the exit. So they get to a stage where they now have to sell because of sickness or whatever, and then it's too late. So planning the exit of your business is very important. And that talks to succession planning, etc., etc.
Yeah, Gerrit, so you addressed it earlier, and it was quite interesting when you said, you know, oftentimes you find entrepreneurs and they built up this business over, let's say, a 30-year period, you know, and they spend so much time and energy in this. So it's almost like it's their little baby, you know, and now they're contemplating selling. So it's almost like giving this baby to someone else, you know, and now you've got responsibility for this. But this could be an extremely emotional period, you know. So how do you juggle or manage the emotional side of this transaction with the fact that this is a business transaction? We need to think in business terms, especially if it's a family business. Maybe it might be a second or third generation family business, but what would you recommend be the process, or how do you manage this, the emotional side of this?
I think that is why it's very important that you've got a skilled person that helps you through this process. For the exact reason, you know, business owner might be very emotional, and look, part of this process is identifying weaknesses in a business. You know, that's what a purchaser needs to do when they do a due diligence on your business. They're going to touch on weaknesses, etc. The last thing you want is an emotional seller that takes offense and actually, you know, just walks away from the transaction. So that's why when I manage a sale of a business, I'm always the in-between. You know, if the purchaser has got a request, it comes to me. I know how to and who to ask within the business. Some of the questions I might address to the CFO, not to the owner, because I know, and a lot of times I would even try and negotiate with the purchaser and get a solution prior to involving the owner, because I know it might be an emotional or issue for him, which could kill the deal. So, and it's not just that; it's also emotions within the business that needs to be managed. Because the biggest risk when you're selling your business is there will be a lot of suitors. Some of these suitors will just be interested.
They just waste your time.
They waste your time. So one of my jobs is to quickly identify serious investors and purchasers, and the other guys to push them off the table quickly, not even introduce them to the owner. So it's very important that you've got somebody that's got experience managing this whole process, because your employees, as soon as they find out about a potential purchaser, they lose security. They start looking for jobs. So it's very important how you manage this process. I typically don't advertise the businesses that I've got on my books. I try to identify the right purchasers, and I approach a few selected investors because of that. I've seen businesses really get hurt throughout this process.
Gerrit, so let's say we've got an interested person that's looking to sell their business. What would be the valuation method? So how do we determine what's the value of this business?
Yeah, so each situation is different. Each industry is different. It is the best valuation method, in my opinion, is the discounted cash flow method. But beauty is in the eye of the beholder.
Okay. What is a discounted cash flow method in layman's terms?
So in layman's terms, you try and determine the future cash flows of the business, the sustainable future cash flows of the business, and then you would...
So in a normal year, not an exceptional year, so in a normal year.
Yes, and then you would discount those cash flows back to present value to determine a value at your required rate of return as an investor. Okay. Now, when you value a business, it is in the eyes of any purchaser is going to evaluate those cash flows, but each of them might have different required rates of return on their investments. Business in one purchaser's hand and another purchaser's hand would have a different value, because they might have existing structures in place and they could save costs, so they'd be willing to pay more. So in each situation is different. To answer that question, but what I do want to mention there is, you see, if you look at some of these tech businesses that are scalable, you see ridiculous price earning ratios and multiples being paid for these businesses. But it's because they are scalable and they can plug into an existing business and generate a huge amount of revenue. Those are the exceptions. Typically, if you look at a run-of-the-mill South African business, if it's not a bolt-on, if it's a bolt-on, I'm able to get a better price for my clients. But if it's a typical business where the client is going to buy the business, keep the existing management in place, it's a lot of times you've got to look at what is a realistic number for this business to be able to finance it, because any potential purchaser is going to bring an element of debt into the business, bank debt. And if the bank is unhappy with the multiple he's paying in terms of earnings versus price, then he's not going to be able to get finance for a component of and then he's not going to buy it. So what I've found is, for in a lot of cases, the business is worth what the bank's prepared to finance.
Gerrit, so let's say there's an entrepreneur out there, or a family business owner, and now after watching they realize, listen, I think it's time to sell my business. I think I don't want to keep on going. I want to retire. I want to enjoy life. What would you say is the process? What would you recommend? What's the next steps?
So I would say, plan 2 to 3 years in advance, getting an expert in, advising you, valuing your business, analyzing your business, advising as to where you need to implement changes, where you need to identify personnel that can take over in certain areas. I think that would, and maybe what you typically do is you do an evaluation on the current as it currently stands, and on the status quo. And once you've implemented these processes, what that change in valuation could be. So my advice would be, get expert advice in to help you strategically plan your exit.
Yeah, okay, that makes sense. And if people are interested in getting a valuation, how can they reach out to you? Can they connect with you?
Our business is called Exit Strat. So we typically help owners exit their businesses. A lot of my clients, some of the businesses I'm selling now, have approached me 3 years ago, and I gave them advice on what needs to be implemented, and I said to them, listen, come back to me once you've implemented these, and it helped me so much. It was so much easier to sell this business. The pool of investors that were interested in the business, once these procedures have been implemented, just was bigger, and then it's easier to sell the business, and you're able to get a better price as well.
Great stuff. Gerrit, thank you for joining us today. It was a very informative conversation. For our viewers, if you are interested in maybe selling your business, or if you would like advice and say, listen, what is this thing I've created, this business I've built over all these years, what is it actually worth? Then I'd really recommend reaching out to Gerrit. If you would like more information, there will be information in the description below, a link in the description below where you can actually reach Gerrit. And then if you've got questions around how do you value your business and how do you take the next steps, he'll be able to help. If you found this video informative and you would like to take the next step, learn more about retirement planning, learn more maybe about selling your business to be able to retire, then hit that subscribe button and like this video and share it with someone who might benefit from the content we share. My name is Hardi Swart. This is Family Wealth. Keep on investing into your future.